To understand the concept of interest, I'm going to give you an example. Assume that you need a car because your car is in a repair shop. You go to a car rental agency and you borrow a car. You use the car for a certain period of time, and then you return the car and you pay rental fees. Borrowing cash is very similar. If you need cash to buy a house, to buy a car, or run your business, you go to a bank, borrow cash. The rental fee that you pay on borrowing the cash is called interest. Once you're done using the cash, you'll return the principal amount that you borrowed and pay interest or rental fees for the cash. Since the fees and the cash are of the same unit, you can consider that you borrow money today, a certain amount, and you return a larger amount in the future. This is the concept of interest. How do we calculate interest? The simplest form is called simple interest. It is computed only based on the original sum that you borrow. So for example, if you borrow a certain amount of money called P for n periods of time, and then at a simple interest rate of I per period, your total interest can be calculated by multiplying P times interest rate times n, number of periods. And the total amount of money that you owe after n periods of time will be the principal amount plus PIN, or it would be P times 1 plus IN. So let's assume that you hold the money only for one period, then the total amount of money you owe after one period will be the original amount of P times 1 plus I. Most of the time, the money that you borrow is not on a simple interest rate loan. Most of the time, it would be a compound interest. A compound interest is calculated on the total unpaid balance, which means that it will include not only the principal amount, but also on the unpaid interest as well. So let's say you borrow an amount of money, is called P, for n periods at the compound interest rate of I per period. So at t equals 0, you borrow the money for the amount of P. At the end of period 1, the amount that you owe will be P times 1 plus I. And if you want to figure out what the amount of money you owe after period 2 is, you would calculate the previous amount that you owed, which is P times 1 plus I, multiply that by another 1 plus I. So that means that at the end of period 2, the amount of money you owe will be P times 1 plus I to the power of 2. At the end of the nth period, the amount of money that you owe will be P times 1 plus I to the power of n. The formula for this is going to be written in the form of F, or future value of money, equals P, present value of money, times 1 plus I to the power of n. So you borrow P amount of money at the present day, and you can calculate how much money you will owe at a future date. The reverse of this can be written as P equals F over 1 plus I raised to the power of n. This introduces the concept of the time value of money. So you may borrow $1,000 today at the present day. In the future, it will have a different value. That value depends on the interest rate and the number of periods you'll hold this money. If you have the future value, or you're saving towards a future value of savings in your savings account at a certain interest rate for a certain period of time, you would be able to calculate how much money you have to invest today. There is a relationship between P and F.